Picture this. You are sitting at your kitchen table on a Tuesday morning, sipping coffee in your pajamas, when suddenly your phone buzzes. You check it and see a notification that $1,000 just landed in your bank account. This wasn't from a grueling 60-hour work week or a stressful side hustle. It was a profit-sharing payment from companies you own. This is the reality of dividend investing. Welcome to the Money Mindset channel. I'm here to simplify the math of passive income so you can stop trading your time for a paycheck and start building a legacy. Before we break down the numbers, do me a favor. Like this video, subscribe to the channel, and comment below with the name of the city you're watching from. Don't skip a single second of this guide. You need to see the exact math calculations at the end to know if your retirement plan is actually on track. The yield trap, why 12% is often fool's gold. To master your financial future, you must understand dividend yield, the percentage of your investment that a company pays back to you annually. While it is tempting to hunt for the highest numbers, look at the data. Company A offers a stable 3% yield, while Company B flashes a 12% yield. At Money Mindset, a 12% yield is often a massive red flag. Think of it as a clearance sale for damaged merchandise. An unusually high yield often means the stock price has cratered because the business is failing. Chasing these numbers is a yield trap that can lead to permanent capital loss. An unusually high yield often signals that either the company is struggling and the stock price has plummeted, or the company is paying out more than it can actually afford, which means those generous payments might disappear faster than free donuts in an office break room. The conservative roadmap, the $400,000 benchmark. If you value sleep and sustainability, the conservative approach is your gold standard. This strategy targets a 3% yield by investing in boring but unbreakable companies like your local utility provider or the massive retailers where everyone shops. To generate $1,000 a month, $12,000 per year, at a 3% yield, you need a capital base of $400,000. While that might sound like a mountain, this approach is a wealth-building superpower. These companies don't just pay you, they give you annual raises by increasing their dividend payouts year after year, allowing your income to outpace inflation without you ever having to ask a boss for a promotion. The specialized, spicy strategies, REITs and sector bets. If you want to hit that $1,000 monthly target with less upfront capital, you have to move into spicy territory. These strategies require less cash, but demand a higher tolerance for volatility. Real estate investment trusts. These entities own income-producing real estate and are legally required to distribute most profits to you. It's like being a landlord without the 2 a.m. calls about broken toilets. With yields between 4 and 6%, you only need $200,000 to $300,000 to hit your goal. However, REITs are highly sensitive to interest rate hikes. Sector-specific investing, energy. Putting your money into oil and gas can net yields of 4 to 5%, requiring roughly $250,000. The risk? Energy is a roller coaster. Dividends can vanish the moment oil prices dip.
Individual high-yield stocks. This is the highest risk tier. By picking specific stocks yielding 6 to 8%, you could theoretically reach your goal with just $150,000 to $200,000. But beware, I have seen investors wake up to a 50% dividend cut because the business model suddenly failed. The Dividend Aristocrat secret to sustainability. The money mindset for long-term success involves dividend aristocrats, elite companies that have increased their dividends for at least 25 consecutive years. Reliability. Titans like Coca-Cola, Procter & Gamble, and Johnson & Johnson have paid through recessions, wars, and market crashes. The trade-off is that this dividend income is about as reliable as gravity, and it tends to grow over time. The financial snowball, the power of reinvestment. You don't need $400,000 today. You need a system. By using dollar-cost averaging, investing a set amount every month, you trigger the financial snowball effect. Consider an initial $50,000 investment in a 3% yielding fund. Year 10, through reinvestment alone, without adding another penny, the portfolio grows to nearly $70,000, generating over $2,000 annually. Year 20, the portfolio hits nearly $90,000, producing almost $2,700 per year. The mathematics are ruthless in your favor, provided you don't eat the seeds. If you spend your dividends too early, you kill the tree before it can shade your retirement. Here is the truth most gurus ignore. You don't keep everything you earn. If you want $1,000 in your pocket every month, you cannot target a $1,000 payout. To account for Uncle Sam's cut, you must gross up your target to approximately $1,300 monthly. This ensures that after taxes, you actually net the $1,000 you need to live on. This is why tax-advantaged accounts like an IRA or 401k are non-negotiable. They eliminate the tax drag that slows your snowball. Furthermore, analyze the total return trade-off. To get $1,000 a month from a growth-focused fund, 0.5% yield, you'd need an insane $2.5 million. However, a growth portfolio of just $200,000 could provide that same $12,000 annual income if you simply sell small portions of your shares. While the growth path is mathematically faster, the dividend path offers a psychological edge. It is much easier to stay disciplined when you receive a tangible check than it is to force yourself to sell shares during a market downturn. Whether you choose the conservative 3% path or the spicy individual stock route, the most important step is the first one. Every dividend aristocrat in a billionaire's portfolio started as a single, humble purchase. Building this income stream is a marathon, not a sprint. Are you willing to choose the reliability of the tortoise, or are you still chasing the high-yield hare? If this blueprint helped you clarify your goals, subscribe to Money Mindset and join our community. Share your thoughts in the comments. Are you building a boring $400,000 fortress, or are you taking the spicy route to passive income?